Welcome back to the Emerald Corner. In today's episode, we're going to be answering the question of why exactly can't I deduct my mortgage interest and real estate taxes? Well, hey there. I'm Kimberly Ferguson, CEO and founder of Emerald Expectations Accounting. I'm so happy that you're here. The Emerald Corner is a place where life and business meet. So I want to help you to have a growing and profitable small business while maintaining a life with your loved ones. Today's video is another episode of Tax Tip Tuesday. And for those of you who don't know what that is, Tax Tip Tuesday is where I share with you tips and tricks on how to get ready for tax season, help you to reduce your tax liability, and answer your specific tax questions. So if you have a specific tax question, will you please drop it in the comments below? I would love to make a video just for you. So today's question is all about mortgage interest, real estate taxes, charitable donations, all that fun stuff, right? But before we jump into that, I want to introduce you to something you may have already heard of, but that is a standard deduction. So on your individual tax return, you don't have to pay taxes on your entire income. The government gives a standard deduction that you can subtract from your income in order to reduce your taxable income, okay? So this standard deduction is something that's set by the government. It's something that you don't have a say over. Depending on what your filing status is, it might look a little bit different, okay? So 2023, these are what your standard deductions are, okay? If you file single and married filing separately from your spouse, your standard deduction is $13,850. If you are filing as head of household, your deduction is $20,800. And if you're filing jointly with your spouse, the deduction is $27,700, okay? Now, these are your standard deductions for 2024, so for the upcoming year, okay? If you are single or if you are filing separately from your spouse, you will get $14,600 as your standard deduction. If you're filing as head of household, then you'll get $21,900. And if you are filing jointly with your spouse, you'll get $29,200, okay? So the other option to the standard deduction is to itemize your deduction. So in order to make sure that your tax situation is the best that it can possibly be, if your standard deduction is more than your itemized deductions, you're going to take the standard. And if your itemized deductions are more than your standard deductions, you're going to take the itemized deductions, okay? So what things can be included in the itemized deductions, okay? So your itemized deductions consist of several different things, and they're filed on a Schedule A, okay? So that includes your medical expenses, but these medical expenses have to be over 7.5% of your income, okay? So if you make $100,000, your medical expenses have to be more than $7,500 in order to take this deduction, okay? Then we have our taxes. So we've got state and income taxes, we've got real estate taxes, we've got personal property taxes, we have sales tax on like if you buy a car or big purchases like that. Then we also have your home mortgage interest and points that you might have paid on your home mortgage. And we also have charitable donations, any kind of contributions that you're making to a charity or nonprofit. And lastly, we have casualty and theft losses. Okay, that one's not a very common one, but if you have those items, they can be included there as well. Okay, so if you add up your medical expenses over 7.5%, all of your state income taxes, all of your mortgage interest and points, your donations and any losses that you had, and it is more than the standard deduction that I showed you at the beginning, then you'll itemize. If it's less, then you'll take the standard. And so if your itemized deductions are less than the standard, that is why your accountant might be telling you that you can't take those deductions or that they don't need all that information anyways, because they know you won't reach that maximum. This happens a lot with married couples who have, a house that they purchased a long time ago, or people who have a really low interest rate or low real estate taxes. They may just say that there's no reason for you to send that information because you're just not going to get higher than the standard deduction, okay? So hopefully that helps you. But again, if you have any specific tax questions, will you please leave them in the comments below. Thank you so much for spending a few minutes of your time with me today. I hope you have a fantastic day, and I'll see you in my next video.